We are back in chapter 2. We are on slide number 20. So recognition, derecognition. Financial statement elements are recognized when they meet the definition of an element. So you will have read through the definitions of the asset, liability, and so on. They give relevant information that faithfully represents the underlying transaction. They used to include this, they don't anymore. No probability or measurement criteria. But if there is significant uncertainty as to existence or measurement, say the stock market was in a really fast climb or really fast fall, the information may not be useful anyway, so you may not use it. Okay, and we'll talk about that when we get to financial investments. Okay, starting on slide 21, we're going through all the different principles, the foundational principles. So you're going to pretty much read these yourself. So economic entity assumption, you studied it last time. Read, remember you keep your personal separate from your business, that kind of thing. So read through that, make sure it makes sense. 22, control. Now control is one that might be new to you. It's an important factor in determining entities to be consolidated and included in an economic entity. Now, this you're not going to use a lot unless you go and take advanced accounting, financial accounting. Accounting 410. You'll be doing all that. So just read through it. You'll have to know it at a basic level for this chapter, but some of it is share ownership, some of it depends on some qualitative characteristics. But this is a good enough summary. The revenue recognition principle, you guys should know this inside out. It's recognized when it's earned. Risks and rewards have passed or the earnings process is complete. So you can read that. And that's ASPE's. IFRS's is slightly different. Remember, IFRS standards, the international standards, are made for a huge number, over 100 different countries that are dealing with this. So everybody had their own accounting system, and as more and more people join, they're trying to make the standards clear enough for everybody and able to be applied with different understandings across the different economic situations. So there's actually a 5-step approach. We will do this in chapters. So you don't have to memorize this or anything. You can just read over it, and we will do it in detail in chapter 6. Slide 25. And again, you guys, I'm going over these quite quickly because you actually have to read them. And short of me reading every single line, which is much slower than you actually reading, right? Because we can read a lot faster than we can talk. It just doesn't make sense for your quality or your effectiveness of your time. Okay. So on slide 25, we've got the matching principle. Expenses are matched to revenue. So the same time period. And you can read about that. Now, measurement. So those are all when to recognize, when to take off your books. These all have to do with measurement. And you can read. Don't forget, estimates are the things that give rise to uncertainty. So, for example, allowance for doubtful accounts. Unless we're dealing 100% in cash, some of our accounts may not be collected, so we estimate them. So, example where there's uncertainty, you can't objectively measure it. You can use last year's estimates, but compare last year to this year after COVID hit. There will be high rates of doubtful accounts, most likely. Existence uncertainty, does it meet the recognition criteria? And outcome uncertainty, determining future outflows and inflows. So, this would be allowance for doubtful accounts. This would be consignment goods. Should we have the assets on our books? Does it meet the recognition criteria? Outcome uncertainty, that would be the future costs of cleanup and restoration, say, of a gas station. So we're going to record that as a liability when we buy it, but those are future costs, so we have to estimate. Slide 27, we've got to determine the level of uncertainty that's acceptable, use appropriate measurement tools, and then disclose sufficient information to indicate the uncertainty. We have to make sure we have the right measurement basis. It's got to be relevant information that faithfully represents. Notice these two qualitative characteristics playing off against each other. New IFRS framework specifies historical costs or current values, where current values are value in use, or current costs. So on page 28, or slide 28, of those 10 principles, 5 are associated with measures. So periodicity, economic activity can be divided by official time, most common a month, a quarter, and a year. So you can just read through that. Again, these are things last year, so they should be a review. Slide 29, monetary unit assumption. Money is the common unit of measurement of economic transactions. So this seems basic, right? All of our transactions are in money. But that means, let's say two businesses exchanged goods in a barter type situation. So you do some accounting work for me and I'll give you the vegetables from my farm. Well, we can't measure them in vegetables and accounting work, so we have to translate it into money. So that's pretty much all that says. Other than generally we're saying inflation or deflation is ignored. In countries like Brazil in the past who've had crazy inflation, they have a different way of measuring it. But you don't need to worry about that. Okay, moving on. The going concern assumption, we assume a business enterprise will keep operating, so read through this. Basically, it's saying only use liquidation or net realizable value if the company's going to be liquidated. The historical cost principle. Measured at the amount of cash or equivalents paid on the fair value of the initial transaction. So in intro, you're used to usually exchanging cash or an item where you specifically knew the fair value. We're going to delve into some transactions in this course where it will look like you could use the same value, but for other reasons you shouldn't. For example, you have outside arm's length party. So we should have that. If you don't have it, then you can't necessarily use the fair value. But again, don't worry about that yet. We will go through it when we go through the other chapters. So on slide 32, more about the historical cost principle. Non-monetary transactions, that's hard sometimes to measure. Non-monetary, non-reciprocal transactions like donations, that's hard. Usually you do it at fair value, or as close to that as you can approximate. Related party transactions, so they're not at arm's length, then you use exchange value or cost. So again, read this. Don't worry too much. We will do examples of this in separate chapters. So each of these will kind of show up in different chapters. Now, the fair value principle, defined differently slightly under IFRS and ASPE. So IFRS, the price received to sell an asset or to transfer a liability. Fair value under ASPE would be agreed upon in an arm's length transaction. It does not refer to an orderly market like IFRS does, nor does it stipulate the price is an exit price. So to sell, that would be exiting. So again, just read through that. And again, we'll talk more about this because there are several instances where we are going to use fair value to measure things in many of the chapters. Because remember, this course is the asset side of the balance sheet, so there's a lot of fair value stuff here. Slide 34. The fair value principle. Basically, you've got the purchase price. Then you've got the values, so while you're using it. Then you've got an exit price, so that's what we mentioned in the last. The fair value is based on the exit price. So that's what we're going to use. And again, we'll talk about this more as we go through. Just understand a fair value principle means we can use the fair value of the asset to measure it on the financial statement. That's it. Okay, just before we do slide 35, I'm going to end it and start the next section.